While Washington remained trapped in another cycle of legal warfare and political crisis, Canada was quietly preparing something far more consequential behind the scenes. Not another retaliatory tariff package, not another emergency negotiation, not another carefully scripted diplomatic statement designed to delay a trade conflict already entering its 21st month. What happened in Ottawa at exactly 9 a.m. on a Thursday morning was something far more ambitious than a policy response. It was the public unveiling of a national economic redesign. Prime Minister Mark Carney introduced a 340-page strategic blueprint before Parliament, an a document transmitted simultaneously to every G7 trade ministry and released publicly with legislative sourcing, implementation schedules, and long-term restructuring targets already built into the framework. This was not written like a temporary response to political pressure. It reads like a government preparing the country for a fundamentally different economic future. Its operating principle was simple, direct, and unmistakable. Reduce Canada's structural dependence on the United States to a level no future American administration can use as leverage again. The plan is called One Canada. Its projected cost over 7 years is $1.07 trillion. And according to officials familiar with the early reaction inside Washington, the scale of it caught the administration completely off guard. Not just the price tag, the completeness, the preparation, the fact that it was not introduced as an idea under discussion, but as a framework already funded, legislatively enabled, and operationally underway. Even the title carried a message beyond economics. In the middle of a trade war during which American political rhetoric had repeatedly described Canada in terms that implied economic absorption or dependency, the phrase One Canada functioned as a declaration of sovereignty as much as a fiscal program. One country, one economy, one future directed from Ottawa, not Washington. And perhaps most importantly, the $1.07 trillion was not presented as an aspiration. It was broken into line items, fiscal phases, funding instruments, and implementation authorities already attached to enabling legislation introduced simultaneously with the announcement itself. Infrastructure bonds, domestic manufacturing incentives, a sovereign wealth mechanism tied to natural resource revenues, trade diversification mandates built directly into federal procurement systems. By the time American trade officials began reviewing the executive summary, debate on the legislation had already started in Parliament. Canada did not announce intentions. It announced decisions, and those are very different things. Because governments negotiate intentions, markets price decisions. That distinction explains why Thursday morning sent such a shock through financial and political circles on both sides of the border. The deeper story, however, began long before the public unveiling. One Canada was not written in a rush during the final weeks of negotiation breakdowns. Its origins trace back to month 4 of the trade conflict, when senior Canadian officials reportedly reached a conclusion that would change the trajectory of the country's long-term economic planning. The conclusion was this: the conflict might not be temporary. For months, Ottawa had treated the trade war the way modern allied governments usually treat bilateral disputes: painful, disruptive, but ultimately solvable through diplomacy, economic compromise, and institutional pressure. That assumption survived the first tariffs. It survived the counter tariffs. It even survived the early negotiation failures. But around month 9, confidence in eventual normalization began collapsing inside Canada's policy apparatus. According to officials familiar with internal planning discussions, Canadian analysts started recognizing a pattern they considered strategically alarming. American negotiators arrived without serious compromise proposals, departed without measurable progress, and publicly framed every breakdown as Canadian responsibility before discussions had even formally concluded. To Ottawa, that suggested something important. The trade measures were no longer tactical. They were becoming structural. And if the pressure itself had become structural, Canada's response would eventually need to become structural too. That was the moment the Privy Council office reportedly established a specialized policy unit known internally as the Structural Resilience Group. Its mission centered on a single question. If economic friction with the United States becomes permanent rather than temporary, what must Canada build to remain prosperous without dependence on American economic goodwill? The group spent roughly 12 months assembling data, economic models, infrastructure assessments, trade projections, and industrial forecasts. The result was reportedly a massive analytical document, drawing from multiple independent economic institutions and long-range market modeling. That analysis became the foundation of One Canada. Its findings identified three major vulnerabilities. The first was energy dependence. Canada exports enormous volumes of energy southward through infrastructure systems designed overwhelmingly around American markets. Pipelines, transmission corridors, refining networks. So, our decades of continental integration had created an architecture where much of Canada's energy economy effectively pointed in one direction, south. The second vulnerability was supply chain integration. Entire Canadian manufacturing sectors, automotive, aerospace, advanced materials, had become embedded so deeply into American production systems that tariff disruption in one area produced cascading economic damage across multiple industries. The third vulnerability involved financial exposure. The Canadian economy, though sovereign, remained heavily influenced by American monetary conditions, investment flows, and cross-border financial structures. In other words, the trade war revealed that integration created leverage, and leverage creates vulnerability when political relationships deteriorate. The Structural Resilience Group reportedly concluded that marginal adjustments would not solve the problem. Canada would need scale, real scale, infrastructure scale, industrial scale, financial scale, not temporary protection, permanent redirection. The number eventually attached to that transformation was staggering, $1.07 trillion over 7 years. By the time the plan reached Parliament, its political choreography had already been carefully engineered. Members of the House of Commons reportedly received only limited notice before the announcement session, though the language used internally signaled extraordinary importance. Observers later described the chamber atmosphere as unusually tense, not partisan tension, but historical tension. The feeling that something foundational was about to be introduced. At exactly 9 a.m., Carney entered carrying a single leather-bound copy of the One Canada framework. No notes, no visible briefing materials. He placed the document in front of him and delivered a 47-minute address entirely from memory. The speech itself was methodical rather than theatrical. That was intentional. Rather than relying on patriotic rhetoric or emotional appeals, Carney reportedly structured the presentation like a national risk assessment, transitioning into an engineering blueprint. The numbers came first. Energy diversification, $287 billion directed toward east-west pipeline systems, Atlantic LNG infrastructure, and Pacific export capacity designed to connect Canadian resources more directly to Europe and Asia. Manufacturing sovereignty, $234 billion in domestic production incentives, industrial modernization programs, accelerated depreciation frameworks, and supply chain localization strategies. Trade diversification, $198 billion targeting new export relationships with Europe, the United Kingdom, India, Japan, South Korea, and Pacific markets. Financial resilience, $167 billion aimed at reducing structural exposure to American monetary and banking pressure. Social stabilization, $183 billion dedicated to workforce retraining, regional transition support, and economic adaptation in sectors most exposed to trade war disruption. For nearly 40 minutes, the speech built layer upon layer of economic logic. Then came the central figure, not delivered dramatically, simply stated. The Total investment required to secure Canada's economic sovereignty, Carney said, is $1,070 billion. Then the line that transformed the announcement from policy into doctrine. Canada has the resources. Canada has the institutions. Canada has the will. And as of this morning, Canada has the plan. A brief pause followed. Then two words. One Canada. The applause reportedly lasted nearly a minute. But while Parliament reacted, the machinery behind the plan was already moving. Documents were being uploaded publicly. International partners were receiving implementation frameworks. Financial terminals across New York, London, Frankfurt, Tokyo, and Singapore were flashing the numbers. And Washington was still trying to determine whether this represented escalation, negotiation, or something entirely different. That confusion shaped the White House response later that afternoon. Officially, the administration characterized One Canada as an extreme and counterproductive escalation. But the statement revealed a deeper problem. Washington responded as though Canada had made another negotiating move inside the existing trade conflict. In reality, Canada had begun constructing an alternative economic architecture designed to outlast the conflict itself. That distinction matters enormously. A negotiation move invites a counter move. A structural transformation changes the landscape underneath the negotiation entirely. And that is what markets recognized almost immediately. The first market reaction was panic. The Dow dropped sharply as investors tried to absorb the implications of a $1 trillion restructuring plan between two of the world's most integrated economies. Automotive equities fell hard because North American manufacturing supply chains suddenly looked less permanent than investors had assumed. Energy markets reacted to the possibility that Canadian exports could increasingly bypass American systems in favor of Atlantic and Pacific routes. But the second phase of market reaction was even more important. Because after the initial shock faded, analysts began asking a much larger question. What happens if Canada actually succeeds? What happens if 7 years from now, Canada is significantly less dependent on the American market than at any point since the late 20th century? That question forced investors to confront something many had avoided throughout the trade war. The pre-conflict baseline might never return. That realization reportedly produced some of the most serious internal discussions major corporations had held during the entire dispute. Supply chains built around permanent continental integration suddenly looked vulnerable. And then came comments from Warren Buffett that amplified those fears dramatically. According to accounts from those present, Buffett described One Canada not as a temporary reaction, but as a directional shift with long-term consequences. His key observation was simple. Costs can be negotiated. Structural investments create momentum. Once infrastructure is built, export corridors established, supply chains redirected, and financial incentives locked into national planning frameworks, economics begins reinforcing the new direction automatically. That was Buffett's central point. One Canada was not merely spending money. It was attempting to reshape incentives. And incentive structures, once operational, become self-sustaining. The historical comparison he reportedly invoked was the Marshall Plan, not because the situations were identical, but because both involved massive state-backed investment intended to permanently redirect economic orientation. The Marshall Plan redirected Europe toward the American economic sphere after World War II. One Canada, in Buffett's framing, aimed to reduce reliance on that sphere. The mechanism was similar, even if the direction was reversed. That observation carried enormous implications. Because if Buffett was correct, then the issue was no longer tariffs. It was geography, economic geography. North America's post-Cold War integration model depended on the assumption that deep interdependence would remain politically stable indefinitely. One Canada suggested Canada no longer trusted that assumption. And once trust disappears from integrated economic systems, redundancy replaces efficiency. Countries begin building alternatives, alternative routes, alternative buyers, alternative supply chains, alternative alliances. That process is expensive. But once it starts, it develops its own political and economic constituency, which is exactly why the legislative dimension of One Canada matters so much. The enabling framework moved rapidly through Parliament because opposing it politically became extraordinarily difficult. Energy provinces supported the infrastructure spending. Industrial regions supported the manufacturing protections. Labor groups supported workforce transition programs. Export sectors supported trade diversification. The framework had been designed carefully enough that nearly every major constituency could identify direct benefits. That completeness is what distinguished One Canada from earlier Canadian responses during the trade conflict. Previous actions had targeted specific pressure points. One Canada targeted the entire structure simultaneously. Energy, finance, trade, manufacturing, labor, infrastructure, foreign investment, national resilience, everything at once. And because the framework was designed around long-term implementation rather than short-term retaliation, it no longer depended on how the trade war ended. That may be the most important strategic point in the entire story. One Canada does not require continued conflict to justify itself. Even if relations improve later, the infrastructure it creates will still exist. Pipelines will still operate. Export terminals will still function. Trade agreements will still diversify markets. Manufacturing incentives will still shape investment decisions. The momentum will continue because the investments themselves create returns. That is why many analysts now describe Thursday morning as potentially irreversible. Not irreversible politically, irreversible economically, because once billions become hundreds of billions and hundreds of billions become infrastructure, supply chains, jobs, ports, factories, and financial systems, reversal becomes extraordinarily expensive. The trade war may eventually end, but the Canada emerging from it may not resemble the Canada that entered it. And Washington now faces a challenge far more difficult than responding to tariffs. It must confront the possibility that its closest economic partner has begun preparing for a future where dependence on the American market is no longer treated as a strategic advantage, but as a strategic risk. That realization changes everything. Because negotiations can pause, tariffs can be suspended, diplomatic rhetoric can soften. But foundations, once poured, continue hardening whether political weather changes or not. And One Canada is not being presented as a temporary measure. It is being built as a foundation. The legislation is advancing. The financing mechanisms are active. International frameworks are moving into implementation phases. Infrastructure planning has already begun. The 7-year clock is running. And every month that passes converts another portion of Canada's economic future from proposal into physical reality. Washington spent 21 months preparing for countermoves. What it now confronts is something far more difficult. A neighboring country redesigning its economic future around the assumption that structural dependence on the United States must never again become unavoidable.